Listen, what I'm about to share with you challenges everything Wall Street wants you to believe about retirement income. The secret isn't in the amount you've saved, it's in how you deploy it. In the next few minutes, I'm going to walk you through these breakthrough principles that transform my own portfolio and the portfolios of countless investors I've mentored over 7 decades. And if you stay with me until the end, you'll discover exactly how to generate substantial annual income from what financial advisors claim is not enough to retire on. So before we dive in, do me a favor, hit that like button, subscribe if you haven't already, and tell me in the comments where you're watching from, because this is about reclaiming control of your financial future. And I want to know how many of you are ready to stop accepting conventional limitations and start creating real wealth. Here's what nobody tells you about money after 50 and why it changes everything. You know what drives me absolutely crazy? When I hear financial advisors telling people over 50 that they don't have enough saved to retire. You need $2 million, they say. You should only withdraw 4% per year. Keep saving for another decade before you can enjoy your life. Let me tell you something with absolute certainty after 70 years of investing experience. That advice is designed for people who don't understand how money actually works. I bought my first stock in 1936 when I was 12 years old. I've spent every single day since then studying how businesses generate profits and how ordinary people can capture a piece of that profit for themselves. And here's what 7 decades of experience has taught me: the difference between people who struggle financially in retirement and people who thrive has nothing to do with how much money they saved. It's everything to do with how they deploy that money. It's the strategy they use to generate income. Now, I know exactly what some of you are thinking right now. Charlie, $25,000 from $150,000 is almost 17% per year. That's impossible. That sounds too good to be true. That sounds like one of those scams. And you know what? I respect that skepticism. You should be skeptical of anyone promising unrealistic returns. But here's what I need you to understand. I'm not talking about speculative gains. I'm not talking about hoping your stocks go up and praying they don't crash. I'm talking about a systematic approach to generating income from your investments that combines dividend stocks, strategic positioning, and techniques that the wealthy have been using for decades to generate consistent income regardless of what the market does. Let me take you back to 1974 for a moment. The stock market had just crashed. We were in the middle of stagflation, inflation running at double digits, unemployment rising. The Dow Jones had fallen almost 50% from its highs. Every newspaper, every magazine, every television expert was screaming at people to get out of stocks, to hide in cash, to wait for better times. And do you want to know what I was doing? I was buying. I was accumulating shares of quality companies at prices that seemed insane at the time, but turned out to be the opportunity of a lifetime. But more importantly, and this is critical, I was focused on something that most investors completely ignored: income, not price appreciation, income. Because I understood something fundamental about investing that most people miss entirely. You cannot control what the stock market does tomorrow or next year. You simply cannot. But you can control how much income your portfolio generates. And if your income exceeds your expenses, you never have to worry about market crashes again. You never have to sell at the bottom. You just keep collecting your checks and wait for the storm to pass. That insight has guided my investment philosophy for over 7 decades, and today I'm going to show you exactly how to apply it to your own situation. How to take $150,000 and turn it into a reliable income stream of $25,000 per year. This isn't theory. This isn't academic nonsense. This is practical, actionable strategy that you can implement starting today. Let me start by explaining the foundation of this approach. It begins with understanding the difference between total return and income return. Most financial advisors focus exclusively on total return. They tell you to build a diversified portfolio, wait for it to grow, and then sell pieces of it to fund your retirement. The problem with this approach, and it's a massive problem, is that it makes you completely dependent on market conditions. If the market crashes right when you need to sell, you lock in losses. If you sell during a downturn, you deplete your principal faster than expected. And worst of all, you spend your entire retirement worrying about whether your money will last. The income approach is fundamentally different. Instead of building a portfolio designed to appreciate and then selling pieces of it, you build a portfolio designed to generate income. You focus on investments that pay you regularly, regardless of what the stock price does. And you structure that income to exceed your expenses so you never have to sell anything. Your principal stays intact, generating income year after year after year. That's the foundation of real wealth. Now, let me be crystal clear about something. Generating $25,000 per year from $150,000 requires a more sophisticated approach than simply buying dividend stocks. The average dividend yield on the S&P 500 is only about 1.5%. Even high-yield dividend stocks typically yield 3 to 5%. To generate the returns we're talking about, you need to combine multiple income strategies, and that's exactly what I'm going to teach you right now. The first component of this strategy is building a foundation of high-yield dividend stocks. Not just any dividend stocks, stocks that have been specifically selected for their high current yield and their ability to maintain those dividends through economic cycles. These are typically found in specific sectors that have structural reasons to pay high dividends, and understanding these sectors is absolutely critical. Let me tell you about the first sector, real estate investment trusts, or REITs. These are companies that own and operate income-producing real estate. By law, REITs must distribute at least 90% of their taxable income to shareholders. This legal requirement, this structural feature of the market, is why REITs consistently offer higher yields than typical stocks. Many REITs yield between 5 and 8%, with some yielding even higher. But you can't just buy any REIT and expect success. You need to focus on REITs with strong fundamentals, stable tenants, and long track records of maintaining their dividends through every kind of economic weather. I look for REITs that own essential properties, medical office buildings where doctors and hospitals lease space, single-tenant retail properties leased to recession-resistant businesses like drugstores and dollar stores, industrial properties, and warehouses that benefit from the growth of commerce. These are the types of properties that generate stable rent payments regardless of economic conditions. If you allocate $50,000 of your $150,000 portfolio to a diversified basket of high-quality REITs yielding an average of 7%, you generate $3,500 per year in dividend income. That's your foundation. Stable, reliable income from real estate without the hassle of being a landlord, without the midnight phone calls about broken pipes. The second sector I focus on for high yield is business development companies, or BDCs. These are essentially publicly traded private equity firms that lend money to middle market companies. Like REITs, BDCs are required to distribute at least 90% of their income to shareholders. And because they're lending money at high interest rates to companies that can't access traditional bank financing, the yields are substantial. Many BDCs yield between 9 and 12%. Now, I need to warn you about BDCs because I respect your intelligence too much to sugarcoat this. They're riskier than REITs. The companies they lend to can default on their loans, especially during recessions. So you need to be selective, extremely selective. I look for BDCs with experienced management teams who've been through multiple economic cycles, diversified loan portfolios that spread risk across industries, conservative leverage ratios, and long track records of maintaining their dividends through the tough times. There are maybe a dozen BDCs that meet these criteria, and those are the ones you want to own. If you allocate $30,000 to a diversified basket of high-quality BDCs, yielding an average of 10%, you generate $3,000 per year in dividend income. Combined with your REIT allocation, you're now generating $6,500 per year. We're making real progress, but we're not done yet. The third high-yield category is energy infrastructure. I'm talking about companies that own pipelines, storage terminals, and processing facilities. These companies collect fees for transporting and storing oil and natural gas. They're essentially toll collectors on the energy highway. And because their revenue is based on volume rather than commodity prices, their cash flows are remarkably stable regardless of whether oil is at $50 or $100 per barrel. Quality energy infrastructure companies yield between 6 and 9%, and the best ones have been paying and increasing their distributions for decades. I look for companies with long-term contracts that guarantee revenue streams, investment-grade credit ratings that signal financial stability, and diversified asset bases that protect against regional downturns. These are the workhorses of the energy sector, generating consistent income year after year. If you allocate $20,000 to a diversified basket of energy infrastructure companies yielding an average of 8%, you generate $1,600 per year. Combined with your other allocations, you're now generating $8,100 annually. That's a solid foundation, but to reach our goal of $25,000, we need to add another component to this strategy. And this is where it gets really interesting. The secret weapon that transforms good income into extraordinary income, the fourth and most powerful component of this income strategy, is selling covered calls. This is a technique that most retail investors have never used, but it's one of the most reliable ways to generate income from stocks you already own. And once you understand how it works, you'll wonder why nobody ever taught you this before. Let me explain exactly how it works in plain English. When you own shares of a stock, you have the right to sell those shares at any time at the market price. A covered call is when you sell someone else the right to buy your shares at a specific price by a specific date. In exchange for selling them this right, they pay you a premium, cash in your account immediately, regardless of whether they ever exercise that right. Let me give you a concrete example that'll make this crystal clear. Suppose you own 100 shares of a stock trading at $50 per share. That's $5,000 worth of stock. You could sell a covered call with a strike price of $55 expiring in 30 days. The buyer pays you, say, $1 per share. That's 100 total. That $100 is yours to keep no matter what happens next. If the stock stays below $55, the option expires worthless. You keep your shares, you keep the premium, and you can sell another covered call for the next month and collect another premium. If the stock rises above $55, the buyer exercises their option, and you sell your shares at $55. You made $5 per share in capital gains plus the $1 premium. Either way, you win. That's the beauty of this strategy. Here's why this is so powerful for income generation. By selling covered calls consistently on stocks you own, you can generate an additional 8 to 15% per year in premium income on top of any dividends those stocks pay. That dramatically increases your total income yield. This is how wealthy investors have been generating income for decades, while regular investors just sit and hope their stocks go up. Now, let me show you how this applies to your portfolio. Suppose you allocate $50,000 to a basket of stable blue-chip stocks. Companies like those in the consumer staples sector, utilities, or large-cap value stocks. These stocks might yield 2 to 3% in dividends, so about $1,250 per year. But if you sell covered calls on these positions consistently, you can generate an additional 10% in premium income. $5,000 per year in option premiums. Combined with the dividends, your $50,000 allocation is now generating $6,250 annually. That's a 12.5% yield. Let me add this to our running total and show you where we stand. REITs, $3,500. BDCs, $3,000. Energy infrastructure, $1,600. Blue chip stocks with covered calls, $6,250. So far, $14,350. We're getting closer, but we still need to generate another $10,650 to reach our goal of $25,000. Here's where we get more aggressive with the covered call strategy. Instead of just supplementing dividend income with covered calls, we can use covered calls as the primary income source on a portion of the portfolio. There are exchange-traded funds specifically designed for this purpose. They own portfolios of stocks and systematically sell covered calls on those positions, distributing the premium income to shareholders monthly. These covered call ETFs typically yield between 10 and 14%. And because they're diversified across many stocks, the risk of any single position hurting you is reduced. They do this professionally with teams dedicated to optimizing the strike prices and expiration dates to maximize income while managing risk. This is sophisticated portfolio management available to you with the click of a button. If you allocate the remaining portion of your portfolio, let's say $50,000, to a combination of covered call ETFs yielding an average of 12%, you generate $6,000 per year in additional income. Let me recalculate our total. REITs, $3,500. BDCs, $3,000. Energy infrastructure, $1,600. Blue chip stocks with covered calls, $6,250. Energy infrastructure, $1,000. Total annual income, $20,350. We're close to our goal, but not quite there. To bridge the remaining gap, let me introduce one more technique: cash secured puts. This is the mirror image of a covered call. Instead of selling someone the right to buy shares you own, you sell someone the right to sell you shares at a specific price. In exchange, they pay you a premium. Here's how it works. Suppose you have $10,000 in cash that you're willing to invest in a stock if it drops to a good price. You sell a put option with a strike price below the current market price. The buyer pays you a premium. If the stock stays above the strike price, you keep the premium and your cash. If it falls below, you buy the shares at the strike price. But you effectively paid a lower price because of the premium you collected by cycling cash through cash-secured puts. You can generate an additional 5 to 10% per year on your cash reserves. If you keep $20,000 available for this strategy and generate 8% in premium income, that's $1,600 per year. Now let me give you the final tally, and I want you to see how all these pieces work together. REITs at 7% yield on $50,000 equals $3,500. BDCs at 10% yield on $30,000, $3,000. Energy infrastructure at 8% yield on $20,000 equals $1,600. Blue chip stocks with covered calls at 12.5% on $50,000 equals $6,250. The $20,000 we allocated to covered call ETFs at 12% generates $6,000. And cash secured puts generating 8% on our remaining cash of approximately $20,000 adds $1,600. Let me add this up. $3,500 plus $3,000 plus $1,600 plus $6,250 plus $6,000 plus $1,600 equals $21,950. We're very close. And here's the thing. I've been conservative in these estimates. Many high-quality REITs yield closer to 8%. Some BDCs yield 11 or 12%. Covered call strategies can generate 15% or more in favorable market conditions. By optimizing each component, reaching $25,000 is absolutely achievable. Are you starting to see why I get so frustrated when financial advisors tell people they can't retire when they say $150,000 isn't enough? They're stuck in old thinking. They don't understand these strategies, or worse, they don't want you to understand them because it makes you less dependent on their services. The truth about risk, trade-offs, and why this works when traditional advice fails. Now, let me be completely honest with you about the trade-offs and risks involved in this strategy, because nothing in investing comes without trade-offs. And I would be doing you a tremendous disservice if I didn't explain them clearly and directly. First, high-yield investments carry higher risk than low-yield investments. There's a reason REITs and BDCs yield more than treasury bonds. They're riskier. Companies can cut their dividends. Defaults can occur in loan portfolios. Energy infrastructure companies can face regulatory challenges. You're being paid to take on this risk. The key is managing that risk through diversification and careful selection of quality investments within each category. This isn't about chasing the highest yield. It's about finding sustainable yields from quality companies. Second, covered call strategies limit your upside potential. When you sell a covered call, you're agreeing to sell your shares at a specific price. If the stock rockets higher, you miss out on those gains. You still make money. Let me be clear about that, but not as much as you would have if you'd simply held the shares. This is the trade-off for generating consistent income. You sacrifice some upside potential in exchange for reliable premium income. Third, this strategy requires more active management than a simple buy and hold approach. Covered calls expire. You need to roll them to new positions. You need to monitor your holdings and make adjustments. This is not a set it and forget strategy. If you're not willing to spend a few hours per month managing your portfolio, this approach may not be right for you. But let me ask you this. Is a few hours per month too much to ask for financial independence? Fourth, option strategies have tax implications. Premium income from selling options is typically taxed as short-term capital gains, which is taxed at ordinary income rates. This means a portion of your income will go to taxes. In a tax-advantaged account like an IRA, this isn't an issue, but in a taxable account, you need to factor this into your planning. Now, let me tell you why I believe these trade-offs are worth it for someone over 50 with $150,000. The alternative is what? Following conventional advice and withdrawing 4% per year, which gives you $6,000 annually, putting everything in bonds yielding 3% and getting $4,500, waiting another decade to retire while inflation erodes your purchasing power and you lose precious years you can never get back. The reality is that for someone over 50, time is your most precious resource. You can't wait another 20 years for your portfolio to grow. You need income now. This strategy provides that income while keeping your principal largely intact. That's what makes all the difference. Let me tell you a story that illustrates why this matters so much. Back in the late 1970s, I knew a man named Frank. He was 62 years old with about $180,000 saved for retirement. Every financial advisor he spoke to told him he didn't have enough. They said he needed to work another 10 years, save more money, build a larger nest egg. Frank was devastated. He'd worked his whole life and was facing another decade of labor just to reach some arbitrary number that kept moving further away. Frank came to me and asked what I would do in his situation. I told him about income investing, about focusing on cash flow rather than total return, about building a portfolio designed to pay him rather than a portfolio designed to grow. We worked out a strategy similar to what I've described today, high-yield investments combined with covered call strategies to maximize income. Frank retired at 63. His portfolio generated enough income to cover his expenses. He didn't have to touch his principal. And here's the beautiful part, because he was generating income rather than selling shares, market crashes didn't hurt him. When we had market downturns, and we had several over the years, Frank just kept collecting his dividends and option premiums. He didn't panic. He didn't sell at the bottom. He just waited it out while his income kept flowing. Frank lived until he was 89 years old, 26 years of retirement. And when he passed, his portfolio was actually larger than when he started because the income exceeded his expenses and he was able to reinvest the surplus. His children inherited more than he started with. That's the power of income investing. That's what I want for you. Not stress about market crashes, not worry about whether your money will last, just reliable income that lets you enjoy your life and spend time with the people you love while you still can. Now, let me walk you through exactly how to implement this strategy, because knowing the theory is absolutely useless if you don't know how to put it into practice. And I want you to succeed. I want you to experience the freedom that comes from financial independence. Step one is to open or use an existing brokerage account that allows options trading. Most major brokerages offer this capability, but you need to apply for options trading permission. For covered calls and cash-secured puts, you typically need Level 1 or Level 2 options approval, which is relatively easy to obtain. Don't let this intimidate you. If you can open a checking account, you can do this. Step 2 is to divide your portfolio according to the allocation I described. Roughly $50,000 to REITs, $30,000 to BDCs, $20,000 to energy infrastructure, $50,000 to blue-chip dividend stocks for covered call writing, and keep $20,000 in cash for cash-secured puts. Adjust these numbers based on your specific situation and risk tolerance, but maintain the general balance. Step 3 is to research and select specific investments within each category. For REITs, look at companies that have paid consistent dividends for decades. For BDCs, research companies with experienced management teams and conservative leverage. For energy infrastructure, consider companies with investment-grade ratings and diversified asset bases. For your covered call portfolio, select stable blue-chip companies with liquid options markets, consumer staples companies, large utilities, major banks, companies whose stock prices are relatively stable because that makes covered call strategies more predictable and profitable. Step 4 is to learn how to sell covered calls, and this is simpler than most people think. Your brokerage platform will have an options chain that shows all available options for any stock you own. You select an expiration date, typically 30 to 45 days out. You select a strike price, typically 5 to 10% above the current stock price. And you sell to open the call option. The premium is immediately credited to your account. That's it. That's the whole process. Step 5 is to manage your positions over time. When options approach expiration, you either let them expire worthless and sell new ones, or you roll them forward to a new expiration date. This is a routine process that takes maybe an hour or two per month once you get the hang of it. You develop a rhythm, a routine, and it becomes second nature. Step 6 is to monitor your income and adjust as needed. Track how much income each component of your portfolio is generating. If one area is underperforming, investigate why and make adjustments. The goal is consistent income, and that requires ongoing attention, but this isn't burdensome. It's empowering. You're taking control of your financial life. Let me address some common questions and concerns, because I know some of you are thinking about these things right now. What if the market crashes? This is actually when income strategies shine. During major market downturns, dividend-paying stocks drop in price just like everything else. But most quality companies maintain their dividends. Investors who focused on income kept collecting their checks and waited for the recovery. They didn't have to sell at the bottom to fund their expenses. Their income gave them the ability to be patient, to ride out the storm. What about inflation? This is a legitimate concern with any income strategy. The good news is that dividend growth stocks tend to increase their dividends over time, which provides some inflation protection. Additionally, covered call premiums tend to increase during periods of higher volatility, which often coincides with inflationary periods. The strategy isn't immune to inflation, but it provides better protection than bonds or cash. Is this strategy appropriate for everyone? No. This strategy requires a higher risk tolerance than traditional retirement approaches. It requires willingness to actively manage your portfolio, and it requires understanding of options trading. If any of these things aren't true for you, a simpler approach might be more appropriate. But if you're willing to learn, if you're willing to take control, this strategy can transform your retirement. Can you start with less than $150,000? Absolutely. The principles work at any scale. The specific allocations might be different, and you'd need to adjust your income expectations accordingly. But the core strategy of combining high-yield investments with covered call income generation works whether you have $50,000 or $500,000. The percentage returns are what matter. What if you need more than $25,000 per year? Scale up the strategy. If you need $50,000 per year, you need approximately $300,000 deployed in this strategy. The math scales linearly. That's the beauty of a systematic approach. Let me leave you with some final thoughts that I want you to really absorb. The traditional retirement advice, the advice that says you need millions of dollars and decades of saving before you can retire. That advice serves the financial services industry, not you. It keeps you working longer, paying more fees, feeling anxious about your future. It benefits them, not you. The income approach I've described today puts you in control. It generates cash flow that supports your lifestyle. It reduces your dependence on market appreciation. And it can work with amounts of money that traditional advisors would say are insufficient. This is about reclaiming your power, your independence, your freedom. I've been investing for over 70 years. I've seen every kind of market condition imaginable. I've lived through the Great Depression, multiple recessions, crashes, booms, everything. And I can tell you with absolute certainty that the principles underlying this strategy are sound. High-yield investments exist because investors demand compensation for taking on risk. Covered calls generate income because other investors are willing to pay for upside potential. These are fundamental market mechanisms that have worked for decades and will continue to work as long as markets exist. The question isn't whether this strategy works. The question is whether you're willing to learn and implement it, whether you're willing to spend the time understanding these concepts and putting them into practice, whether you're willing to take control of your financial future rather than outsourcing it to advisors who may not have your best interest at heart. If you're over 50 with $150,000, you have options. You don't have to accept the conventional wisdom that says you can't retire. You don't have to work another decade saving for some arbitrary number. You can start generating income today, building a foundation that supports your lifestyle and grows over time. That's what I would do. That's what I have done. And that's what I'm sharing with you today because I believe you deserve to enjoy the fruits of your labor while you still have the health and energy to do so. Your life is happening right now, not in 10 years, not when you hit some magic number. Right now. And you have the power to change your financial situation starting today. So here's what I want you to do. Take action. Don't just watch this and do nothing. Start researching the companies I mentioned. Open that brokerage account. Learn about options trading. Take the first step today. Because every day you wait is another day you're leaving money on the table. Another day you're accepting limitations that don't actually exist. You've got this. You're capable of more than you realize. And I'm here cheering you on every step of the way. Now go out there and build the retirement income you deserve. Start today. Start now. Your future self will thank you.